There is a moment in every commodity market cycle where the paper market, the futures complex, the derivatives, the leveraged positions, loses its ability to set the price. It is not a dramatic event. It does not come with an announcement. It comes with a data point, a very specific, observable, measurable data point that tells you the physical market has become larger than the paper market's ability to manage it. In silver, that data point is the relationship between COMEX registered inventory and total open interest. I have covered this in detail on this channel. In gold, that data point is something different, and it is the data point that I believe is showing the first signs of the paper market losing control of gold pricing right now. Today, in this market, not in a future cycle, not in a historical retrospective, right now. When the paper market loses control of gold pricing, gold does not move 5%. It does not move 10%. The historical instances of gold paper market control breaking down, 1971, 1980, and briefly in the March 2020 gold lease rate spike, produced gold price moves measured in multiples, not percentages. And when gold's paper market breaks, the silver paper market, which is smaller and thinner, breaks faster and harder. Today, I am going to show you the specific data point that is moving toward the paper market control threshold. I am going to show you what losing control means mechanically, how it has played out historically, the specific trigger levels to watch in both metals, and what the correct positioning response is for an investor who understands what is building. This is the most urgent video I have made on this channel. Let's go. To understand what losing control means, I need to explain how paper markets control prices in the first place. Commodity futures markets set prices through a mechanism called price discovery. The futures price, determined by the interaction of buyers and sellers in the futures market, becomes the reference price for physical transactions. When you buy physical gold from a dealer, the price they quote is based on the futures market price plus a premium for fabrication, delivery, and dealer margin. The futures market sets the baseline. This works smoothly when the physical market and the paper market are in equilibrium, when the paper claims on the commodity and the physical supply of the commodity bear a reasonable relationship to each other. But commodity paper markets have a structural feature that creates the potential for disconnection. The paper market can be many times larger than the physical market. More paper claims on the commodity can exist than physical metal in existence. This is by design. Futures markets are meant to be markets for risk transfer and price discovery, not markets for physical delivery. The assumption is that most contracts are settled in cash or rolled without delivery, and only a small fraction result in actual physical movement. The mechanism works until it does not. It works until the percentage of contracts demanding physical delivery exceeds what the registered physical inventory can accommodate. When that threshold is crossed, the paper market cannot maintain its reference price relationship to the physical market because the physical market is pricing the commodity at whatever it takes to source the necessary physical supply, which is a different number from the futures price. The data point I am watching in gold right now is not the COMEX registered gold inventory, though that is worth watching. It is the gold lease rate. The gold lease rate is the interest rate at which physical gold can be borrowed for a specified period. Under normal conditions, gold lease rates are low and stable. There is plenty of gold available to borrow, gold lending is routine, and the rate reflects the mild scarcity of short-term gold lending versus the abundance of long-term gold holdings. When gold lease rates spike, when the cost of borrowing physical gold suddenly increases significantly, it means that physical gold is not freely available to the entities that need it for short-term delivery, settlement, or short covering. It is the price signal of physical scarcity entering the market. Gold lease rates have been moving in a direction that deserves urgent attention. The benchmark gold lease rate, which had been running near historical low levels through most of the past 2 years, has been rising in the past 6 weeks. The move is not dramatic yet. We are not at the levels that preceded the March 2020 gold dislocation event. But the direction and the pace of the move are the signals that matter. 6 weeks ago, the 1-month gold lease rate was at approximately 0.15%. Today, it is at approximately 0.68%. That is a 4-fold increase in the borrowing cost of physical gold in 6 weeks. Not a small move, not within the range of normal seasonal variation. Here's why this move matters beyond the absolute numbers. The gold lease rate rises when the supply of gold available to be borrowed from central banks, from custodians, from holders willing to lend their gold in exchange for a return, becomes less than the demand for gold borrowing. Who borrows gold? Short sellers borrow gold to establish short positions. Banks borrow gold to fulfill delivery obligations when they have committed to deliver physical gold they do not yet possess. Market makers borrow gold to provide liquidity against futures positions that may require physical delivery. When lease rates rise, one of three things is happening. Short sellers are increasing their demand for borrowed gold, which happens when short pressure on gold increases. Or delivery obligations are increasing, which happens when more futures contracts demand physical delivery than the system expected. Or the supply of gold available to lend is declining, which happens when gold holders, including central banks, stop lending their gold and instead hold it without lending, a behavior that has been documented among several central banks that are building reserves and not offering them for lease. All three potential explanations for rising gold lease rates are consistent with the broader picture I have been building throughout this video. Increasing short pressure that is being met by stronger physical demand, increasing delivery demand as the physical paper gap widens, and central bank gold holders choosing to hold rather than lend, which confirms their strategic view that gold is going higher and they do not want to create supply through lending. Let me walk you through March 2020 because it is the most recent documented episode of the gold paper physical tension reaching a visible breaking point, and the lessons from that episode apply directly to what is building now. In March 2020, as pandemic-related financial stress created a dash-to-dollar liquidity event, gold initially sold off with other assets as institutions liquidated everything to raise dollar cash. But simultaneously, physical gold demand exploded. Private investors, alarmed by the financial stress, wanted physical gold immediately. The combination of paper market selling and physical demand surge created a dislocation. The spot gold price in London, the price for immediate physical delivery, diverged sharply from the COMEX futures price, the price for delivery in 1 to 3 months. The spread between London spot and COMEX futures, which normally runs a few dollars per ounce, widened to more than $60 per ounce at the peak of the dislocation. The gold lease rate spiked dramatically during this episode, as banks that had committed to deliver gold against futures contracts suddenly found that the physical gold they needed to borrow for delivery was unavailable. The lease rate went from near zero to several hundred basis points in a matter of days. The episode resolved because the Federal Reserve intervened with emergency repo operations that provided dollar liquidity, reducing the forced gold selling, and because the COMEX changed its delivery contract terms to allow for broader delivery flexibility. The paper market was stabilized through institutional intervention and contract modification. But here is what happened to the gold price during and after this episode. Gold, despite the initial sell-off to $1,477 in mid-March 2020, moved to $2,075 by August 2020, a 40% move in 5 months. Precisely because the March episode demonstrated that physical gold could command a significant premium over paper gold when conditions stressed the delivery mechanism. The March 2020 episode was a preview, a stress test that revealed the paper market's vulnerability, and then the world went back to normal, or so it appeared, and the lease rate normalized, and most of the commentary moved on. The current lease rate movement is not at 2020 levels, but the direction is the same and the structural context is more extreme. The central bank accumulation removing float from the lending market, the physical demand from Asia increasing, and the geopolitical fragmentation creating supply chain complications that did not exist in 2020. The conditions that produced March 2020 are more structurally embedded in 2026 than they were in March 2020. The next dislocation event, when it comes, may not be resolved as quickly or as completely as the 2020 episode was. Let me now connect the gold paper market analysis to silver, because the silver paper market is structurally thinner, less liquid, more concentrated, and will respond more dramatically to any gold paper market stress event. The silver futures market, compared to gold, has lower absolute liquidity, a smaller pool of commercial participants providing price-making services, a higher concentration of short positions in fewer hands, and a physical delivery mechanism that is already more stressed relative to registered inventory. These structural differences mean that any systemic stress that affects the gold paper market will affect the silver paper market faster and harder. When gold's lease rate spikes, silver's lease rate spikes more. When gold's registered inventory is under pressure, silver's registered inventory, which is at a more extreme paper to physical ratio, is under proportionally greater pressure. The interconnection between the two markets also creates a direct transmission mechanism. The large commercial participants who manage short positions in both gold and silver manage them together as part of integrated precious metals books. When stress develops in the gold book, rising lease rates, increasing delivery demands, rising mark-to-market losses, those same participants' silver positions come under pressure simultaneously. The covering or defensive repositioning in gold creates sympathetic pressure in silver. This transmission mechanism means that the gold lease rate movement I am watching is not just a gold signal. It is a signal for both metals simultaneously. And silver, as the thinner and more physically constrained of the two markets, is the one where the stress event, when it comes, will produce the larger and faster price move. The COMEX silver data I have covered, 7.3 paper claims per registered ounce, 53% decline in registered inventory from its peak, Shanghai physical premium running $10 to $12 above COMEX, is the silver-specific stress picture. Overlay the gold lease rate signal on top of that silver-specific stress picture, and what you have is a dual metal paper market that is under increasing stress in both components simultaneously. The moment the paper market loses control of gold pricing, it loses control of silver pricing simultaneously. And silver, with its more extreme physical deficit and its additional industrial demand floor, potentially moves further and faster than gold in a paper market dislocation event. Let me give you the specific trigger levels I am watching for both metals and the positioning response each level warrants. For gold, trigger level 1, gold lease rate at 1.5%. We are at 0.68% today. If the lease rate reaches 1.5%, it signals that physical gold borrowing has become sufficiently scarce to strain the delivery mechanism for participants with near-term delivery obligations. At that level, the risk of a dislocation event like March 2020 is elevated. The positioning response at trigger level 1 is to reduce or eliminate any short-duration leveraged gold positions that require the paper market to remain stable and to ensure physical holdings are fully secured in allocated storage. Trigger level 2, gold lease rate at 3% or higher. This level would be approaching the March 2020 spike territory. At this level, the probability of a visible paper market dislocation, a widening London COMEX spread, delivery failures or near failures, emergency exchange interventions, becomes significant. The positioning response at trigger level 2 is maximum allocation to physical gold and silver, maximum defensive posture in mining equities, and complete avoidance of leveraged or derivative positions that depend on paper market stability. For silver, trigger level 1, COMEX registered silver below 60 million ounces with open interest above 450 million ounces implied. We are close to this level already, 71 million registered, which is 15% above trigger level 1. If registered silver drains another 15%, the paper to physical ratio deteriorates to a level that has historically preceded visible delivery stress. Positioning response. Add to physical silver. Begin building quality senior silver miner positions. Silver trigger level 2. Shanghai physical premium above $15 per ounce, sustained for more than 10 consecutive trading days. We are at $10 to $12 now. A move to $15 and sustained holding at that level would indicate that the physical paper gap has widened to the point where routine arbitrage mechanisms have completely broken down. Positioning response. Maximum allocation to physical, highest urgency to complete any planned additions. The most important positioning takeaway is this. The time to complete positioning in both metals is before the trigger levels are reached, not after. When gold lease rates spike to 3%, when silver premiums hit $15 and hold, when the paper market is visibly losing control, that is not the entry point. That is when the prices have already moved. The entry point is now, when the lease rate is 0.68% and rising, when the silver premium is $10 to $12 and building, when the registered inventory is declining and the signals are clear to those doing the work. The most important summary I have given you on this channel: gold lease rates are rising from 0.15% to 0.68% in 6 weeks, a fourfold increase, the same directional signal that preceded March 2020's dislocation event. This is the gold paper market's first visible stress signal. March 2020 precedent. London COMEX spread widened to $60. Lease rates spiked to hundreds of basis points. Gold moved 40% in the following 5 months. The structural conditions in 2026 are more extreme than in 2020. Silver paper market is thinner, more concentrated, and more physically stressed than gold. When the gold paper market shows stress, silver's response will be faster and larger. The COMEX silver data, 7.3 to 1 paper to physical ratio, $10 to $12 Shanghai premium, is silver-specific stress layered on top of the gold lease rate signal. Trigger levels to watch. Gold lease rate at 1.5% and 3%. Silver registered inventory below 60 million ounces. Shanghai premium above $15 sustained. Positioning window. Before the trigger levels, not after. The entry point is not the dislocation. It is the building of the conditions for dislocation, which is precisely where we are right now. Subscribe. If this analysis is the level of depth you need to navigate this market correctly, the subscribe button is the mechanism that keeps it coming. Share this video with one person who holds gold or silver and does not yet understand the lease rate signal. Comment below. What level are you watching, and how close do you think we are to trigger level 1? Tell me your read. Stay alert, stay positioned. The paper market's control of these prices is not permanent, and the moment it ends will define the decade for the investors who are ready.